segments and use those segments to study yield curve behavior and the sensitivity of one's financial position to each of those segments. Now these ideas seem commonplace, but at the time the world of bonds was almost unbelievably primitive, at least in the world of actual bonds, and the market for forward rates was nearly non-existent. Try to imagine, for example, what it was like to extract a continuously compounded forward rate curve from the traded bond market, even if one used data from the Treasury market, possibly the deepest and most liquid bond market in the world. The results could be almost hilariously erratic. In contrast, with Eurodollar futures, one had the next best thing, a quarterly compounded forward rate curve, served on a platter. Well, almost. It's one thing to know that convexity matters, and another to know just how much. In the late 1980s, Terry Belton and I published a piece for our clients at Discount Corporation of New York Futures called The Financing Bias in Eurodollar Futures. The idea was a simple one, based on the daily settlement of gains and losses on futures. That is, if one were short Eurodollar futures, one would be able to invest cash coming in at higher rates, i.e. when rates were going up and you were making money on your short position, and borrow the cash you paid out at lower rates when rates were falling. This was an obvious advantage to the shorts, and if you could do it long enough and over big enough swings, the advantage could add up to real money. At the time we published the note, though, the Eurodollar futures curve only went out a year or two, and the advantage proved not to be worth much for such short-dated contracts. So that research note sank without a trace. In time, though, the CME extended the Eurodollar futures curve out to 5 years, and then to 10 years, and when it did, the interest rate swaps market used these newly available futures rates to price their swaps. The problem, though, as Bill Hoskins and I discovered when we published The Convexity Bias in Eurodollar Futures, perhaps one of the most important research notes of our working lives, was that the market had failed to take the value of convexity into account. Swaps were priced as if futures rates were forward rates, so that it was possible to receive fixed on a swap and hedge the position by shorting Eurodollar futures and make completely riskless money as rates rose and fell. Not long after we published that note, the market became aware of the mispricing and completely readjusted. Another lesson that Bill Hoskins taught me, although it took him a while, was that forward rates, or prices, are break-even values. That is, if you finance a position to any given forward date, you know just how much the price of what you have can rise or fall before you make or lose money as of that forward date. This is a hugely valuable tool. One example of just how valuable a tool it is came when Gavin Gilbert, a wonderfully valuable friend of mine, rang me one day to announce, more or less at the top of his lungs, "Galen, you won't believe it! I just bought the forward 2-year TED for 0. For this to make sense, you need to know that we had just published a good piece of work called Measuring and Trading Term TED Spreads. This was the basis for much of what you could find on Bloomberg if you visited that particular page. We had not, however, considered the buying and selling of term TEDs forward, but Gavin had. He found that if he bought a 2-year note 2 months forward and sold the appropriate strip of Eurodollar futures, he basically owned the spread at 0. Since the 2-year TED spread at the time was trading at roughly 20 basis points, he expected to make 20 basis points on the trade, and he also knew that the spread would have to go negative